For decades, the US dollar has stood at the center of the global financial system, not just as a currency, but as a symbol of trust, stability, and economic power. It has survived wars, recessions, inflation shocks, and financial crises, yet through it all, the world has continued to rely on it as the foundation of global trade and finance. But as we move into 2026, a subtle but powerful question is beginning to emerge across Wall Street, central banks, and global markets. What happens if the US dollar begins to weaken? At first, this may not seem like a dramatic event. In fact, most people might not even notice it happening. But in economics, the most dangerous changes are often the ones that happen slowly, quietly, and over time. If the US dollar starts to weaken, the first place it shows up is in everyday life. Prices begin to feel slightly higher, even if incomes stay the same. Imported goods such as electronics, clothing, vehicles, and even basic household products become more expensive because the dollar no longer stretches as far in global markets. Gas prices at the pump may start to rise again, not necessarily due to shortages in oil, but because the purchasing power of the dollar itself is declining. This creates a hidden form of inflation that slowly eats away at the value of money, making everyday life more expensive without any obvious warning sign. People may still see the same numbers in their bank accounts, but what those numbers can actually buy begins to shrink. As this process continues, the effects move beyond consumers and into the global financial system. The US dollar is not just used inside America, it is the backbone of international trade. Oil, commodities, and most global transactions are priced in dollars. Countries around the world hold massive dollar reserves as a form of financial security. So when the dollar weakens, even slightly, global confidence begins to adjust. Central banks in different countries start reconsidering how much they rely on the dollar. They may not abandon it, but they slowly begin diversifying into other assets such as gold, the euro, or even emerging alternatives. This shift is not emotional or sudden. It is calculated, cautious, and based on long-term risk management. But even small movements at this level can have massive global consequences. On Wall Street, the reaction becomes even more visible. Investors are highly sensitive to currency strength because it affects everything from corporate earnings to global investments. A weaker dollar creates a mixed environment for markets. On one hand, it can benefit American companies that export goods internationally because their products become cheaper for foreign buyers. This can increase overseas sales for major corporations and give a short-term boost to certain industries. But on the other hand, it increases costs for companies that rely heavily on imported materials, global supply chains, and foreign manufacturing. This puts pressure on profit margins and creates uncertainty in earnings forecasts. And in financial markets, uncertainty is often more powerful than actual data, which leads to volatility. As volatility increases, stock markets may begin to experience sharper swings. Some days may show strong gains driven by optimism, while other days may bring sudden drops fueled by fear and uncertainty. Investors start shifting money between sectors more aggressively, trying to protect themselves from currency-related risks. Safe haven assets such as gold often become more attractive during these periods, as they are seen as more stable stores of value when currencies fluctuate. At the same time, global investors may begin reallocating portions of their portfolios away from dollar-heavy assets, not because they have lost all confidence in the United States, but because they are preparing for a more balanced global financial system. Beyond markets, the geopolitical impact begins to slowly unfold. The US dollar has long been one of America's strongest tools of global influence. It is deeply tied to international trade agreements, global lending systems, and even political power structures. If the dollar weakens, even gradually, it can lead to a slow redistribution of financial influence around the world. Other economies may gain more confidence in challenging dollar dominance in certain areas of trade and finance. This does not mean an immediate collapse of the system, but rather a gradual shift from a single dominant currency to a more diversified global structure. Such transitions are complex and take years, sometimes decades, to fully unfold. However, it is important to understand that a weaker dollar is not automatically a disaster. In fact, in some scenarios, it can create opportunities for the U.S. economy. A weaker currency can make American exports more competitive on the global stage, helping manufacturers, tech companies and industrial sectors sell more products abroad. It can also encourage domestic production and potentially bring jobs back into the country as imports become more expensive relative to local goods. Additionally, it can reduce the real burden of U.S. debt when measured in global terms, which can provide some financial breathing room for policymakers. The impact depends entirely on how the weakening happens, whether it is gradual and controlled or sudden and unstable. So as we move deeper into 2026, the real question is not simply whether the US dollar will weaken, because currency cycles are a natural part of economic history. The real question is how that change unfolds. If it happens slowly and predictably, the global economy can adjust, adapt, and stabilize. But if it happens quickly or unexpectedly, the ripple effects could reshape global markets, trade relationships, and financial strategies for years to come. The US dollar has remained the foundation of the global economy for generations. But like every financial system in history, its strength depends on confidence, stability, and trust. And in the end, when the dollar moves, it is not just America that feels it, but the entire world that responds.